Hey everybody, welcome to Trading Capital's daily analysis video here on June 22nd. Wrapping up today's market session. Overall, it was a pretty mixed session. Energy was extremely weak with the big initial dump and sell-off in oil. Natural gas was flat on the day. Essentially, the S&P and the NASDAQ remained flat on the day, really taking a pause day on this current section. But there were some strong names, specifically around the technology sector, that were a little bit stronger today. You also had the broker dealers, which was the best performing sector on the day. And then you also had real estate, which was strong. Again, the healthcare was strong. Utilities were strong. Consumer staples were flat. The industrials were weak today, down on the day. The material sector was weak, and financials were kind of flat to weak on the day. So a little bit of a mixed market today. Overall, it was pretty healthy action to see the S&P 500 recapture this bullish channel that we're in. It just doesn't seem that the markets are quite ready to give up this channel. So we touched base on this yesterday. This was your pre-Fed meeting channel where it looked like markets were trending up. And then you had the Swiss interest rate hike that sent it down. You were chopping, consolidating in this parallel range before you gapped up, made a nice grind move up yesterday into this channel, held this channel, and then you closed below it at the end of the day, not only to find it that we gapped down this morning, sold off, made a little bit of a pre-market low, and then the markets just ripped up on this beautiful 1, 2, 3, 4, 5, 6, 7, 8, 9 candle count to the upside. Whenever you see a 9 candle move to the upside, you know that there's going to be a sharp pullback. In the live day trade room, we actually shorted it up here and made a beautiful day trade gain. But nonetheless, you notice when you put in that high after that 9 candle count, you did not confirm ever above that high. So that was your high to note, despite you did pull back, rallied back up, made a new interim high. You did fill a technical gap here around the 378. Essentially, it does favor that you still hold this channel since we've had some pretty bad news sell-off, another gap down yesterday on weak market tendencies, and now you're still remaining in this S&P 500 channel. So I do think the markets want to move up ahead of time before eventually giving up this bullish pattern. Overall, your next resistance is going to be at this 388 level. There is a key pivotal gap here that I do think gets filled to the upside, potentially maybe tomorrow or the next day. So I do think there is upside in this market. That being said, beautiful job on the profits today, members. Today we banked 12.63% on our SEO, our short oil trade. Let's just pull up the USO chart since we're touching base on our energy profits. But massive move. So oil closed down 3.74% on the day. At the lows here, it was around down, I think 6.5% at the lows. We covered our SEO short pretty much right at the low of oil, banking a beautiful 12.63%. Now I do think there's a trend line that I want to show you and why we covered our short there. If you simply take this high in March, draw your trend line all the way across, connecting 1 pivot, 2 pivot, 3 pivot, whole bunch of chop and support, and look what you just hit today. Smack bang on at the bottom of the wedge formation. So this wedge formation has incurred technical damage. I do think since you are into support, you've had a nice move down from the highs, basically a $12 move on the USO. I do think you somewhat get a little bit of a bounce, potentially to this gap fill. I will look to start accumulating yet again another short trade on the USO if it comes up to this levels and fill this gap. I do think there is more downside. Now that you've hammered on this trend line once again, I do think it's inevitably going to break due to the slowing of global economies. Okay, so oil demand is getting killed by our central banks around the world due to quantitative tightening. Although there is the backdrop for potentially a limited supply, I do think the demand destruction that has occurred over the last 4 months is aligning with the 2008 demand destruction. In 2008, oil was above $100 a barrel for pretty much exactly 4 months. Last Friday on the big sell-off, oil was exactly over $100 a barrel for 4 months. So it just puts it into perspective that cycles are aligning, demand destruction occurs. That 4-month time frame certainly has yielded a lot of savings to be eaten up and additional expenses for the average consumer. So as well as corporate businesses. Let's not forget oil is it's the highest input cost in essentially all businesses, as it's a direct form of energy use and material use. So congrats on that short trade. We also sold our Teladoc today for a beautiful 16.1%. So congratulations on that trade. And then we also did a couple new trades today, but let's just touch base on the S&P here. So overall, if we flip to the daily chart on the S&P, notice how this is our intraday parallel channel. You've broken out of it, and now you're just doing a little bit of a bullish consolidation. There is a gap fill that could technically come down and fill it, but I do think you still have a move that favors the upside here. And the interesting thing about this gap fill is it will coincide with retracing back to this original parallel channel that we were trading in for several months until we broke down recently. So I do think a move to the 388, 387 mark is definitely probable, but we'll just have to take the price action on the S&P day by day. Looking at the Qs finished flat on the day. Also, you had this gap down, pre-market trading, and then a beautiful, beautiful surge to the upside. Notice how on this surge, whenever you made the high on that 9-bar count, you did not take out that high all day. So now you are making a series of lower highs intraday on the S&P, which is kind of a negative thing. But if you look at the daily chart on the NASDAQ, I think I said S&P before, but the NASDAQ, if you look at the daily chart on the NASDAQ, you are into this resistance here. This parallel channel is now acting as resistance, not once, but twice. So you can clearly see there's sellers stepping in there. But due to the fact that you are holding still a little bit of a bullish consolidation here, and you are consolidating under this channel, it does favor a move to eventually break and pierce through this channel. Your next resistance, your first resistance will be at this 288 mark. Second resistance, if you get through, will be at 298 mark. The 298 mark is certainly going to be a more of an aggressive resistance, but that being said, we'll have to see if the price action gets up to there. Taking a look at natural gas, let's just take a look at the UNG. So the UNG is essentially doing what is expected. And this is what I talked about in previous videos as well, is the fact that you're now tested this 650 area support. This basically, this 2250 area aligns with the 650 area on natural gas. So if we go to the actual natural gas chart, you can see the 650 area. We're just hovering and consolidating above. So this is actually bearish consolidation, what we're doing. And notice how, if you simply go on many different time frames, for instance, the 3-hour time frame, you had a topping tail here, collapsed. You've had a topping tail here, and it does favor a move breakdown to the downside. You also put in on a intraday basis on the 10-minute chart. It's interesting to note that you also put in a intraday topping tail today, right at the high resistance point of that 3-hour topping tail, this previous gap fill. So this is a beautiful consolidation range that we're now trading in, and I do favor a breakdown to the downside. Ultimately, whenever you're consolidating over a major support that was once a massive bounce to the upside, and secondly a massive bounce to the upside again, whenever you arrive at that support zone and you don't get that bounce, it does favor that sellers are lurking and just ready to take this price down as they suck in potential buyers who think this is a massive support zone and natural gas is going to trend up. I'm now in the camp with all the geopolitical issues and essentially slowing global economies, the World Bank revising GDP down by 50%, and the big fact that US is not shipping from their second largest LNG terminal for basically 3 to 6 months is a pretty big ordeal, with the fact that US can now stockpile their reserves as Europe suffers. So it's essentially taking money from the European market and giving this reprieve to the North American markets. But overall, a breakdown should come very soon. Notice how you were consolidating here for 1-2 days and you broke down. We've consolidated for now 1-2-3 days, and potentially I would say on the 4th or 5th day you could look for another sharp move down in natural gas. This could coincide with inventories. We do have inventories, I believe, tomorrow for natural gas, so the EIA should release the reserves. I'm expecting a build. I think the market is expecting a build. It's just more or less whether the market is in line or the build beats expectations. There is a strong probability now that these EIA numbers are going to reflect the LNG terminal in Texas that is currently closed for exports. Now the EIA data is going to start reflecting that terminal specifically. In the last 2 previous EIA reports, we have not had that data reflected. So over the next coming EIA inventory reports, that data should be reflected. So if I just want to bring to your attention that notice off this 650 area, when you hit it, you had a massive bounce and continued follow through for 3 days. Second time here, you had a massive bounce and continued follow through for 3 days. Here, no bounce. A little bit of a bounce in the second candle, met with resistance and sell pressure. Trying to rally above it, met with resistance and sell pressure. So the difference is that when you hit these levels, there were fresh new buyers here. Now when you're hitting this level, the buyers are slowly fading away. Look at the buy volume. Just disgustingly poor. It is decreasing. So just keep that in mind. Don't try to chase natural gas higher, because certainly the macro factors are no longer favoring it. In my opinion, there's certainly still a lot of natural gas bulls and oil bulls. Obviously, understanding what time frame we are is key. Most people who are oil and gas bulls are looking at a time horizon of 3 to 5 years or longer. We as traders are capitalizing on the short-term trends and the long-term trends. I'm not just a long-term viewer where I can sit through a massive drawdown on my position. I'd rather make money on both ends, the short-term and the long-term. And I think it really distinguishes the people who are going to make exceptional amounts of profit and just average amounts of profit. Those who can capitalize the trends and overall technical patterns in the short term will inevitably be able to trade both the short and the long-term patterns more successfully. So potentially more downside to natural gas. I think the next big support area will be around this 588 mark. And don't be surprised once these economic conditions really get nasty that we test the low range of this channel. Will I hold my natural gas short that long? Probably not, but I'm going to try to milk a little bit more out of the natural gas trade. We also added more to our canopy growth trade today. And one of the reasons, I just want to show you the marijuana ETF, MJ ETF. So one of the reasons we added to our short, if we look at the monthly chart on the MJ, this is the marijuana ETF, so it comprises of all the leading marijuana companies. But if you notice that this is the monthly chart, each bar represents 1 month of data. This chart is now into a pivot bottom zone over here, 1, 2, 3 pivots. You're tagging it to a T on a monthly basis. You have had a 3-bar monthly surge to a low, followed by a previous 1, 2, 3, 4, 5, 6, 7, 8, 9 monthly time count consolidation, and then a 3-bar surge to a low. And if what's really interesting to me is if you measure this move down and you measure this move down, it's near identical. It is a completed symmetrical move. And when you notice the last 3-month surge to a low, it followed huge bounce in the markets. Just for instance, from that 3-bar surge to a low, you had a 70% bounce. So it's very similar, even if you count up the 1, 2, 3, 4, 5, 6, 7, 8, 9 candles to the downside, 1 month of consolidation, and then 3 to a downside, it's identical. You have 9 candles to the downside, 1 month of consolidation, and 3 to the downside. Patterns move in symmetry. It's one of the most appealing things to human nature is symmetry, and just the price action of symmetry can be very powerful in identifying levels of support and resistance. But when you have an equally measured move on a monthly time count, I do think the cannabis sector is due for some sort of a bounce in the near term. Maybe it could take 3, 6, 9 months, but I do think that, and I am confident that the marijuana stocks will fly once those midterm election promises start rolling through the door from candidates. We also added to our a new position today, which is Vici Properties. So if we look at Vici Properties, and I just want to show you this monthly chart. Let me first flip to the daily chart. So Vici Properties is really interesting because it is a very, very strong stock, trading above all of its key moving averages, and it's a direct real estate play. So Vici Properties primarily holds a lot of properties in Vegas, in like gambling territories, vacation resorts, hotter climates. So they are really, really exposed, being that their large majority of properties is exposed to the real estate market in Las Vegas, Nevada, the gambling hub of the world. There is a strong probability that when the economy goes into recession, there's going to be less people spending money on casinos and gambling, as it's going to be really people are going to be looking to buy the necessities and not gambling away their life savings. Despite vacations and air travel still going up, people wanting to take vacations, one could still argue you're getting that COVID robust bounce. I do think as the economy slows, the consumer market is going to be hit, in the sense people will be taking less vacations. Therefore, these property values should decline substantially as revenue for these businesses in a sector that is not a consumer staple sector and it's not a need. I do think that Vici Properties will be hit hard, and simply the fact that real estate is arguably so overvalued still. I do think it's only a matter of time before real estate markets takes a massive hit. If you simply look at the weekly chart, this was the COVID crash. It fell about 68% from the peak to the trough, and I do think with this exceptional sell volume on a weekly basis, you can't get a better sell signal than this. When you had an attempted breakout out of this range and you failed, it does now suggest you're going to head to the lower range at the minimum on an exceptional amount of volume. We haven't seen Vici Properties, even at the COVID lows, Vici didn't exchange that many shares. You've had a whopping basically double to more than triple the average in volume just on this weekly sell signal candle here. I wish I did see it a little bit earlier, but I wasn't really paying attention to this property. But nonetheless, I do think we're at a substantially great level. Flipping to the monthly chart, you still have this monthly topping tail put in all the way back in June of 2021, still in effect. And with this failed breakout, I do think it's inevitable that you head back down to the minimum, the low range of this channel. You can see this is your pivot to your pivot. This is kind of your flash crash COVID trend. So we're just going right through that. And this is where the mean reversion trend lies, basically on this trend line. This is the low range. Obviously, if we see a crash again, some sort of a flash crash, then this could test the COVID lows. And you know what? I'd be fine with that since we're on the short side. But overall, a weakening housing market, rising rates, commercial real estate should get hit as delinquency rates go up. And certainly we could see businesses fold. And that's where these commercial type properties like Vici Properties, who are exposed more to the commercial side versus the residential side, could be hit a lot harder than most expect. So, we'll just continue to monitor that and the overall real estate market. But congratulations on the winners. We did also add to our LI short. LI is just getting crazy extended. It is one of the strongest Chinese ADR companies right now. But when you're on a time count on a weekly basis and you've had this massive, massive move up, you're coming into almost a identical symmetrical move as you did over here, and then you had a massive sell-off. So I do think that you're inevitably going to get that pullback. I wanted to add near this double top resistance, and I only added 0.5% there. I will add another 0.5% at this third resistance level if we get up there. Ultimately, Vici on a daily base, Li Auto on a daily basis could go up to this 43.90. There is a gap fill up here that it could be looking to push, but that would be another substantial move to the upside. And the good thing about our trading strategy and style is it leaves ourselves a lot of maneuverability to put ourselves in a great position for even when that minimal conservative pullback comes. I'm not even talking about an intermediate or major pullback, but when the conservative pullback comes, our entry levels allow us to profit even if we get the most conservative pullback in any name. And if we get an intermediate or a major pullback, then it just puts us in a position to profit even more. So we'll just have to continue to monitor that. Overall, our portfolio is currently positioned. Basically, we have 29.2% of our portfolio on the long side of the market, and we have 27.25% of our short on the short side of the market. Now, the thing about there is a 2% advantage to being on the long side. However, on the long side, I have included 2% of our portfolio in gold and 2.5% of our portfolio in silver. So that's 4.5% in precious metals commodities that are on the long side. So realistically, we are net short the market as opposed to long, but I do think we're positioned well in a variety of extremely oversold names like Walmart, which is this consumer staple, a blue chip cap consumer staple, Netflix, PayPal, SLV, HCA, healthcare, Spotify, Lyft have been destroyed. ISRG has been ridiculously hit lately. StoneCo reporting amazing earnings, but just kept getting beaten down in a weak market. Then we have Apple, we're long financials, extremely depressed. American Express, Alibaba. So we have a lot of mixed exposure, and I do think we're tremendously going to continue to profit well into 2022. This has been an incredible profitable month. I just want to congratulate anybody and everybody that did take the trades with us, because this has been one of our most profitable months to date yet. I think still January on the turn of the market was our most profitable month, and then we're kind of in this grind mode, but we have been banking winners left, right, and center, and it's certainly give yourself a round of applause or a pat on the back. It is something to be proud of. Don't try to gloat in the profits, just admire the wins, respect them, and stay humble as we trade. And I think we will be continuing well into 2022 and onwards in terms of growing our swing trading accounts. Thank you again for being members. Please hit a big like or comment down below, and stay tuned for more trade